We're seeing a bit of a bounce in the price of oil right now, but truthfully, it is on a difficult course. It is on the longest weekly losing streak since 2018. There's concerns that demand is slowing down, and maybe all these supply cuts will not be enough to stem that off. Even with that, though, the Canadian energy producers have held up relatively well. They're still down, but not down as much as the price of crude oil. Our next guest covers a bunch of these Canadian producers. Patrick O'Rourke, Managing Director at ATB Capital Markets, joining me in studio. Thanks so much for being with us.
Thanks for having me.
So first, let's just talk about this wild ride for crude. We were looking at $90. We're talking about $100, and then boom, we're back down to $70. What's the sentiment like? Are you surprised by the suddenness of that move?
You know, we were here back in September and we were a little bit bearish on oil prices at that time because some of the demand indicators, especially in the retail markets, were flashing negative for us at that time. The situation that we're in right now, OPEC's showing good discipline, they're extending their cuts, but the reality is there's somewhere between 3.5 and 3.9 million barrels of OPEC spare capacity. And until demand catches up with that and sort of satiates that, you know, the upside is probably a little bit limited in the near term for oil prices.
So does that mean we hang around here? I mean, that's fine for a bunch of producers, isn't it?
You know, prices in the mid $70 range, a lot of these companies are still profitable. We were modeling out $76 for 2024, and we still have companies that are, you know, high single digit, low teen sort of free cash flow yields. So these businesses are sustainable at those prices. But for the Canadian producers, you know, with a little bit of a higher cost structure in some situations, that move between 75 and 85, there's a lot of juice and leverage in there operationally.
And Canadian oil prices have struggled, and the differential is getting wider. How do you see that playing out?
So the WCS differential is wide right now because, you know, we're in an apportionment situation. TMX, I think a lot of the producers had expected it to be sort of line packing by now. We've had a number of delays. We've had another sort of deviation request that is not going to happen. So these delays, they brought on production to sort of match up with when they initially thought, and their scheduling of their turnarounds when they initially thought the pipeline would be on. So the pressure we're seeing on WCS differentials, we think is fairly transitory. And even if you look at the curve, the futures curve for WCS differentials, by mid-year of next year, we go from something like $23, $24 today back to $14.
Okay, so let's take your macro thought. Do you think we waffle around here? Then how do you outperform in a market that is just going to hang out at these prices?
So frankly, stock picking is very difficult right now. That's been the challenge for us. If you go back a year ago, we had a scenario where a lot of the businesses were trading at very similar valuations. And we said, okay, things are easy here because the high quality assets trade at the same price as the low quality assets. Today, that's not the case. So you have to make a decision point between buying high quality long tail resource at a little bit more of an expensive valuation or buying a lower quality company at a cheaper valuation. And that inherently makes things a little bit more difficult.
So how are you doing that?
We're looking for pockets of opportunity where we're seeing mispriced, high quality long tail assets in the market.
What?
So a couple of names that we've been suggesting here, one would be Athabasca. We've been quite bullish on this name for a while. I talked about it last time I was on the show here. You're still getting about a 15% free cash flow yield. In the near term, there's probably some financial challenges because they are exposed to WCS differential. But sitting with $150 million in cash on the balance sheet and an active share buyback problem, they should be able to navigate that near-term market. And then you get out into the second half of 2024, you've got both growth at their core asset at Leesmere, and you've got an improvement in WCS differentials, and then you've got a very long-tail resource with 40 years of reserves here.
And you're one of the most bullish analysts on this stock with a $5.50 price target. All those factors is what gets you there to that price?
Yes, yeah. And, you know, we see some great Duvernay results upcoming in their light oil division as well. And I would say I've been one of the most bullish analysts on this stock, but from what I can see, my peers are starting to catch up with me as well.
When you look at names that you're avoiding, two of them that stand out, Suncor and Imperial, you have sector perform on both of those. Why don't those make the cut in this environment?
Probably a little bit of a different thesis around both of those holds that we have. Imperial, very high quality, great execution. They have an SIB that's winding up this evening, and we'll have the results of that Monday morning. It really comes down to valuation specific to Imperial. We think it's pretty fully valued by the market for that high quality business. And this goes back to the thesis I just talked about, where you have to, pick if you're going to buy a high quality, fully valued business or weaker business at a lower valuation. Suncor, on the other hand, actually, if you look at the short-term valuation metrics on our comp sheet, it looks pretty cheap. But we think that the multi-year mine improvement will probably work out. We just want to see a little bit more on the execution side here. I thought that the budget that they put out earlier in this week, there were some real green shoots in that, but we're going to watch to see how that plays out.